Imagine waking up one morning, looking at your bank account, and realizing that the problem is not that your money disappeared. The problem is that your money has become visible in a way most people never agreed to, never understood, and never planned for. Not just the large transfers, not just the stock trades, not just the wires, every deposit, every withdrawal, every movement between accounts, every large payment to a family member, every piece of cash that enters the banking system, all of it can now become part of a much larger machine. And if you are retired, if you are living on savings, if you are trying to manage Social Security, pension income, medical bills, family gifts, home repairs, and the occasional large expense, this machine can misunderstand you very quickly. The number at the center of it is simple: $10,000. It sounds like a large number because for a long time it was a large number. But in the real world retirees live in today, $10,000 is not a suitcase of criminal money. It can be a roof repair, it can be a used car, it can be a medical bill, it can be a required distribution from an IRA, it can be money for a grandchild's tuition, it can be the proceeds from selling furniture, jewelry, or a vehicle. And this is where the risk begins, because beginning around 2026, the old $10,000 banking threshold is not just an old rule sitting quietly in the background. It is being used inside a modern enforcement system with modern data, modern software, and modern cross-checking. That combination changes the practical meaning of the rule. I want to be very clear about what this means. This is not about whether an honest person is doing something wrong. Most honest people who get caught in these systems have done nothing wrong. The issue is that the system does not begin by understanding your story. It begins by seeing a pattern, and when a pattern looks unusual, the burden can shift to you to explain why it is innocent. That is a very different world from the one many retirees grew up in. Let me tell you about Patricia. Patricia is 71 years old. She is a retired school teacher in Ohio. She spent most of her adult life doing the kind of ordinary work that makes a country function. She taught children, she paid her bills, she saved what she could, she never tried to hide money, she never cheated on her taxes, she never thought of herself as the kind of person the government would ever have a reason to examine every month. Her Social Security payment arrives in her checking account from time to time. She moves money from savings to checking to handle larger expenses. One year, it is a new roof. Another year, it is a medical bill. Another time, she wants to visit her grandchildren. Nothing exotic, nothing hidden, nothing dishonest. But to an automated system, Patricia is not Patricia. She is a set of transactions. A deposit here, a withdrawal there, a transfer from one account to another, a larger movement of money that does not match her ordinary monthly rhythm. That system does not know she taught third grade for 35 years. It does not know she has arthritis, or a leaky roof, or a grandson starting college. It does not know that she is careful, not criminal. It only knows that money moved in a way that may require attention. That is the point most people miss. A financial system built to detect wrongdoing will inevitably pull innocent people into its net when the signals it watches become common in ordinary life. And for seniors, those signals are becoming common. To understand why, you have to go back to the original rule. The $10,000 threshold comes from the Bank Secrecy Act of 1970. The purpose was to help the government identify money laundering, tax evasion, drug trafficking, and other serious financial crimes. At that time, banks were required to file a currency transaction report when a customer deposited or withdrew more than $10,000 in cash. That made sense in the world of 1970. Back then, $10,000 was an enormous sum. It was far more than many Americans earned in a year. It was enough to buy things that today would cost many times more. It was not a normal amount for most families to move casually through a bank branch, but the number never changed. Prices changed, wages changed, homes changed, medical costs changed, retirement accounts changed, the cost of vehicles, repairs, care, and family support changed. But the threshold stayed frozen. $10,000 in 1970 is roughly equivalent to about $80,000 today when adjusted for inflation. So what was once a high threshold aimed at unusual cash activity has become a much lower practical threshold that ordinary retirees can cross in the course of normal life. That is the core of the problem. A rule designed for a different economy is now operating inside a much more expensive one. And because the number was not indexed to inflation, more and more ordinary financial behavior looks reportable, reviewable, or suspicious. A retiree does not need to be a criminal to trigger the system. They only need to live in 2026 with a threshold from 1970. Now, the reporting system has more than one part. The first part is the currency transaction report. That is the report banks file when cash transactions cross the $10,000 threshold. The second part is the suspicious activity report. That is broader. A bank can file it when it believes a transaction pattern may indicate illegal activity, even if no single transaction crosses the threshold. This is where the word structuring becomes extremely important. Structuring means deliberately breaking a larger transaction into smaller pieces to avoid the reporting requirement. For example, if someone has $27,000 and deposits $9,000 on Monday, $9,000 on Tuesday, and $9,000 on Wednesday because they want to stay under $10,000 each time, that can be treated as structuring. And structuring is not a minor technical violation, it can be treated as a federal crime. Here is the part that ordinary people often do not understand. The money itself can be completely legal. It can be from a home sale, it can be from a retirement account, it can be from an insurance payment, it can be from savings built over a lifetime. The legal risk does not come only from dirty money. It can come from the act of arranging the deposits or withdrawals to avoid the report. That is why the innocent retiree can get into trouble. Many older Americans grew up in households where cash felt safer than banks. Some watched parents live through bank failures, recessions, inflation shocks, or times when institutions did not feel trustworthy. They may keep some cash at home. They may make smaller deposits because that is simply how they manage their lives. They may not know the $10,000 reporting threshold exists. They may not know that a pattern under the threshold can be more dangerous than one clean transaction above it. They think they are being careful. The system may think they are hiding something. That gap between intention and interpretation is where the damage happens. There have been real cases in which ordinary citizens and small business owners had money seized because their deposit patterns looked like structuring. Some had not been charged with crimes. Some were forced into long legal battles just to recover their own funds. The money may have been legitimate, but the pattern created suspicion that matters, because modern enforcement is increasingly pattern-based, and pattern-based systems are powerful, but they are not wise. They can find things humans might miss. They can also misunderstand things humans would immediately recognize as ordinary. This is why the discussion around the 2026 bank rule matters so much for seniors. The public debate around broader bank reporting has been building for years. Proposals have come and gone. Some of the most aggressive ideas created public backlash and were scaled back. But the direction of the system has not disappeared. The government has more data. The IRS has been modernizing its analytical systems. Financial institutions have more compliance obligations, digital payments have created more records, and the government can cross-reference information much faster than it could before. That means the old $10,000 threshold is operating in a new environment. The number may be old, but the machinery around it is new. That is the dangerous combination. Let me break down how this can affect retirees in real life. Start with Social Security, pensions, and retirement distributions. For most retirees, monthly Social Security deposits are ordinary and usually far below the threshold. Pension income may also arrive regularly. Those deposits are easy to understand when the tax return and the bank record line up. But retirement is not only monthly income. At some point, a retiree may take a required minimum distribution from an IRA. They may sell investments. They may liquidate part of an annuity. They may move money from a retirement account to a bank account to pay for care, repairs, taxes, or family support. Depending on the size of the account, that distribution can easily exceed $10,000. That does not mean it is improper. It means the documentation has to be clean. If the bank records show money arriving but the tax return does not clearly explain it, or the source is not documented, the system can see a mismatch. Mismatches are what modern data systems are built to notice. Then there are family gifts. Many retirees want to help their children or grandchildren while they are still alive. They may help with a down payment, they may contribute to tuition, they may give money for medical costs, emergencies, weddings, or a first home. That can be generous, legal, and completely normal. But it still needs to be understood within the rules. A large gift or a series of related transfers can create reporting questions. The issue is not whether a grandparent loves a grandchild. The issue is whether the movement of money is documented in a way that makes sense to an outsider. The system does not know the family story. It only sees funds leaving one account and entering another. If the amounts are large, if the timing is unusual, or if the movement is broken into repeated smaller transfers, the pattern can become the problem. Then there are home sales and inheritances. A senior who sells a home may suddenly receive a large lump sum. Maybe they are downsizing. Maybe they are moving closer to family. Maybe they are entering assisted living. The transaction may be perfectly documented at closing, but the money still has to move through the banking system. The same is true with inheritance. After the death of a spouse, a parent, or another family member, money may arrive in amounts much larger than the retiree normally handles. Those funds are legitimate, but legitimacy is not enough if the paper trail is missing, incomplete, or hard to find. When a large transaction happens, you want the explanation ready before anyone asks for it. That is a principle. Do not wait for the question before building the proof. Then there is everyday senior finance. This is the part most people underestimate. A retiree may sell a car, they may sell jewelry, they may sell collectibles, they may receive rent from a tenant, they may hold money temporarily for a family member, they may cash out savings bonds, they may receive an insurance payout, they may pay a contractor, they may reimburse or be reimbursed by relatives. Each one may have an innocent explanation, but a series of innocent transactions can still look unusual when viewed by software with no context. This is why the old mental model is dangerous. The old mental model says, I did nothing wrong, so I have nothing to worry about. The better mental model is, I did nothing wrong, so I should be able to prove exactly what happened quickly and clearly. That is not paranoia. That is operating with reality. Now, what happens when a bank files a report? A currency transaction report or suspicious activity report generally goes to the Financial Crimes Enforcement Network, which is part of the United States Treasury Department. That information can be shared with law enforcement agencies, including the IRS, from there. Analytical systems may compare the banking information with tax returns, reported income, known sources of funds, and other records. Most reported transactions do not result in direct action. That is important to say because fear distorts judgment. The system receives an enormous volume of reports and most people are never contacted. But the fact that most reports do not lead to an audit does not mean the risk is imaginary. It means the risk is probabilistic. And in my way of thinking, when a risk has a low probability but a high consequence, you do not ignore it. You manage it if the IRS decides to look more closely. The process can begin with a letter asking for an explanation or documentation. It may become a formal audit. In more serious cases, it may involve other agencies. In cases where structuring is suspected, there can be asset seizure issues through civil asset forfeiture. Civil asset forfeiture is especially dangerous because it can be financially devastating even when a person is ultimately innocent. If funds are frozen or seized, the account holder may have to prove the money is legitimate and fight to recover it. That can require lawyers, it can take time, it can create stress. For a retiree living on fixed income, having $20,000 or $30,000 inaccessible for months can create a real crisis. That is why preparation matters. The purpose of understanding the rule is not to become afraid of every transaction. The purpose is to make sure your financial life is explainable. An explainable financial life is much safer than a confusing one. The most important protection is records. I know that sounds simple, but simple principles often matter most. If you sell your home, keep the closing documents. If you receive an inheritance, keep the estate documents. If you liquidate a retirement account, keep the statements. If you make a large gift, write down the date, the amount, the recipient, and the purpose. If you sell personal property, keep the bill of sale, messages, receipts, or any proof showing what was sold and why money came in. If a family member sends you money or you send money to them, keep a note explaining it. A notebook can be enough. A spreadsheet is better. Digital folders are better still if you know how to use them. The key is not sophistication. The key is that you can reconstruct the story. A transaction without a story can look suspicious. A transaction with a clean, consistent, documented story is much easier to defend. The next protection is professional guidance. Not every retiree needs an expensive lawyer for ordinary financial life, but when you are moving large sums, gifting money, receiving inheritance, liquidating retirement accounts, or selling property, it is wise to speak with a tax professional who understands retirement income and reporting rules. A good CPA or enrolled agent can help you understand what needs to be reported, what records to keep, how gift rules work, how required minimum distributions should appear, and how to avoid creating unnecessary confusion. This is not about hiding money, it is the opposite. It is about making the truth clear. Good planning reduces the chance that innocent behavior looks suspicious. Another protection is to avoid the appearance of structuring. This is one of the most important practical rules. If you need to deposit or withdraw $12,000 for a legitimate reason, do not break it into two $6,000 transactions just because you think smaller looks safer. Smaller can look worse. One clearly documented transaction above the threshold is often safer than a series of smaller transactions that appear designed to avoid the threshold. Let the report be filed if the law requires it. A report is not a punishment. A suspicious pattern is more dangerous than a clean report. That is a critical distinction. Many people misunderstand it and create risk by trying to avoid attention. In systems, the attempt to avoid a signal can become the signal. You also need to understand your rights. If you receive a notice from the IRS or another agency about bank transactions, do not panic, but do not ignore it. Ignoring a letter is almost always a mistake. Responding emotionally is also a mistake. The right move is to slow down, gather records, and get representation if the amount is significant or the issue is not clear. You have the right to representation. You have the right to respond in writing. You have the right to provide documentation. You should not try to improvise your way through something serious. If you do not understand the rules, a calm response is better than a fast response, and a professional response is better than an emotional one. Families also need to understand the rules. Many seniors do not manage money alone. Adult children may help, grandchildren may reimburse, relatives may deposit money. A trusted family member may have access to an account that can be completely legitimate, but it must be documented and legally authorized. If a child is helping an elderly parent, there should be a proper power of attorney or similar legal authority where needed. Every transfer should have a purpose. Every pattern should make sense if money is being moved for bills, care, repairs, or family support. There should be records. The danger is when family money moves informally, repeatedly, and without explanation. The family knows what happened. The system does not. And if cognitive decline is involved, the risk becomes even greater. As people age, managing money can become more difficult. Automatic transfers, recurring deposits, family help, and multiple accounts can create confusion. That confusion can produce transaction patterns that look odd. It can also create opportunities for scams. If you are helping an older parent or grandparent, do not treat documentation as bureaucracy. Treat it as protection. It protects them. It protects you, it protects the money, it protects the explanation. Scams are another part of the same problem. Criminals often pressure older adults to move money quickly, secretly, or in smaller amounts. They may tell the victim not to talk to family. They may say the transfer must happen today. They may suggest amounts below $10,000. They may use fear, urgency, romance, tax threats, fake legal threats, or false family emergencies. The victim may be innocent, but the transaction pattern can look very bad afterward. That is how a scam can create two injuries. First, the senior loses money. Second, the senior may have to explain a suspicious banking pattern created by the scammer's instructions. So one of the best protections is a pause. If someone tells you to move money urgently and secretly, stop. If they tell you not to tell your bank, stop. If they tell you not to tell your family, stop. If they tell you to break a payment into smaller pieces, stop. Talk to a trusted person before you move the money. In money, pressure is often the enemy of good decisions. Now, there is also an emotional side to all of this. Many honest retirees feel insulted by these rules. They feel that after a lifetime of working, saving, paying taxes, and following the law, they are being treated like suspects. That feeling is understandable. There is a real tension between financial crime prevention and financial privacy. Governments want to prevent money laundering, tax evasion, and fraud. Individuals want to live freely, move their own money, and not be watched like criminals. Both sides of that tension exist, but whether the system is fair or unfair, you still have to operate within it. That is one of the principles I believe in most strongly. Do not confuse what should be true with what is true. You can believe a threshold is outdated. You can believe the system should protect privacy more. You can believe civil asset forfeiture needs reform. You can believe ordinary seniors should not be forced to navigate complex reporting systems. But until the rules change, your job is to understand the reality and reduce your risk inside it. That does not mean being passive. Seniors have political power. Citizens can contact representatives. Organizations have advocated for financial privacy, civil forfeiture reform, and clearer rules. Public pressure has already affected previous proposals. The system can be changed when enough people understand what is happening and push for better rules. But advocacy is slow. Your next transaction may not be. So you need both things. You need the long-term voice of a citizen and the short-term habits of a careful money manager. The direction of the system is also important. Even when specific proposals are scaled back, the larger trend is toward more data collection, more automated analysis, more cross-referencing, and more digital records. Technology makes surveillance cheaper, it makes pattern detection faster, it makes it easier for agencies to compare what you report with what banks, brokers, payment platforms, and other institutions report. That trend is unlikely to disappear, so the habits that protect you are not temporary. Keeping records is not temporary. Avoiding structuring is not temporary. Using professionals for complex transactions is not temporary. Making family transfers clear is not temporary. Understanding your rights is not temporary. These are permanent features of responsible financial management in the modern age. If you are retired, I would think about this the way I think about risk in markets and economies. The risk is not one event. It is a system. The system has rules. The rules create incentives. The incentives create behavior. The behavior creates consequences. Banks have incentives to report and avoid liability. Agencies have incentives to collect data and detect patterns. Software has incentives to flag anomalies. Individuals have incentives to reduce inconvenience. When those incentives collide, the ordinary person can be caught in the middle. That is why you need principles. One principle is that large money movements should have a clear paper trail. Another principle is that you should never break transactions into smaller pieces to avoid a report. Another principle is that family help should be documented. Another principle is that urgent secretive requests involving money are dangerous. Another principle is that a professional should be involved before a complex transaction, not after a problem begins. Another principle is that your financial life should be understandable to someone who does not know you personally. That last one is very important. The system will not understand your character. It will understand your records. So build records that reflect your character. If you are Patricia, the retired teacher in Ohio, the goal is not to stop living your life. It is not to become afraid of your bank. It is not to stop helping family. It is not to stop paying for medical care, home repairs, or travel. The goal is to make sure that when money moves, the reason moves with it. If she takes money from savings to repair a roof, she should keep the contractor estimate, the invoice, and the payment record. If she helps a grandchild, she should write down the amount, the date, and the purpose. If she sells personal property, she should keep the bill of sale. If she receives an inheritance, she should keep the estate documents. If she takes a retirement distribution, she should keep the statement. None of that is complicated, but failing to do it can make a simple transaction look mysterious. And mystery is what compliance systems are designed to investigate. Let me put the central lesson plainly. The $10,000 rule is real, the threshold is old, the cost of life is much higher, the systems around the rule are more advanced, the reporting environment is broader. Seniors are more likely than many other groups to have occasional large legitimate transactions that do not fit their monthly income pattern. That combination creates risk, but risk is not destiny. If you understand the rule, document your transactions, avoid suspicious patterns, get help when the amounts are meaningful, and keep family money movements clear. You can manage the risk rationally. That is the right mindset, not fear, not anger alone, not denial, clarity. The worst position to be in is to learn the rules after your account is frozen, after a letter arrives, after money has been seized, or after a family transaction is misunderstood. The best position is to understand the system before it touches you. You have worked for what you have. You deserve to manage your retirement with confidence. You deserve to support your family without accidentally creating problems for yourself. You deserve to move your own money in a way that is legal, documented, and explainable. But deserving it is not enough. You have to act as if the environment has changed, because it has. The financial world is more traceable than it used to be. The government has better tools than it used to have. Banks are more cautious than they used to be. The $10,000 threshold is easier to hit than it used to be, and ordinary people must be more careful than they used to be. That is the reality. So before your next large transaction, pause, ask where the money is coming from, ask where it is going, ask what records prove the source, the purpose, and the recipient, ask whether a professional should review it, ask whether your family understands the rules, ask whether you are doing anything that could look like structuring, ask whether you would be able to explain the transaction clearly 6 months from now if someone asked. If the answer is yes, you are in a much stronger position. If the answer is no, fix the record before the money moves. That is how you protect yourself, not by hiding, not by panicking, not by assuming the system will understand you, by making the truth easy to see. Because in a world where your money is increasingly read by machines before it is understood by people, the person with the cleanest explanation has the strongest defense. And that may be the difference between a normal transaction and a financial problem you never should have had in the first place.